Yeah, I've actually seen some grandparents that are giving money to the schools that their grandchildren are going to for certain, like a science wing or, a field that's never been redone in the last 50 years. I mean, there's a lot of creative ways you can utilize that money and put it to good use.
Hello and welcome to Unf Your Finances podcast with your host, Nick St. George. I'm your podcast producer, RJ Malik. Nick, you've got a special guest with you, someone you've known for quite a bit of time, huh?
He is special, let me tell you.
Lots of history, right?
Yes, we got Mark Carrison with me. My brother from another mother, the last graduating class of Bryant College, the founding member of Carrison Landscaping, and partner. Are you up to a partner now? Are you that big time?
It will be shortly. Yeah, we're not big on titles at our firm, but we're a firm over 50. So thanks for having me.
No, dragging you, kicking, screaming, forcing you to smile on camera. This is going to cost me.
Yeah, don't be showing this to too many people.
Don't worry. Outside of our mothers, nobody else is going to watch it. So we should be all right. I doubt we get a download in Maine. So we'll be okay. This is the calm before the storm. We're filming this early January. Taxes, we're trying to unf your finances, unf our taxes. On Monday, I got my first request for where my 1099 is. January 6th is the new earliest I've ever been asked for a 1099. This is going to be coming out that first couple weeks in February where you're sleeping underneath your desk, you're getting tortured. Like, I want this to help people just understand, make a little bit of the little less chaos in the tax time. Understand some of the pain points. We've both been enough through tax seasons of you eating at your desk in 18-hour days. I think now that you're big time, maybe it's only 15-hour days, but still, like, what are some of those just, I don't know, those top 3 mistakes you see? Like, you've done taxes for a long time. You're really good at what you do. Truth be told, you do my taxes regretfully. I torture you with all my shit, but what are the top 3 mistakes that just make you lose hair?
Yeah. So great question. What I see on a year in and year out basis is, procrastination is probably the worst thing you can do as a client, that somebody, that you're trying to work with a financial advisor and your tax account to finalize your tax returns, your yearly compliance needs, is you're coming to them last minute. It's just, you already got a finite amount of time. Happy to help you any way we can. But the problem with that being is you're being reactive and that instead of proactive, and you're probably costing yourself some tax dollars too along the way.
And there's nothing worse than trying to do tax planning in March. This is the conversation we needed September, October, November.
Exactly.
Like, unless you got a DeLorean that goes 88 miles per hour, we're not fixing this.
I agree. The days are gone, especially with the technology that we have, that we should be communicating a little bit more effectively, talking in that September, October, November, at the December, obviously at the latest time frame, to make sure that your house is in order, everything makes sense for you from a tax standpoint, going into, the new year and right before year end. And it's just something that you really should try to do. Even if it's just, hey, tax advisor, your CPA is, can you just give me a high level tax projection as far as where I stand year to date? I've had a change in, capital gains. I got a bonus. I got a new rental property. It's very important, I think, to keep that dialogue going and open.
And that's one of those things we can't know that that's there. Like, I can't know that you've been, I don't know, you had an account at another broker deal that you've been messing around with. When I run your financial plan, I didn't even know it exists. As you, the accountant, you don't know that we bought a rental property this year. So you didn't even know to ask about it. So that's kind of, you got to have that open communication. And it can't be New Year's Eve being like, oh, hey, can you look at this? Like, you can't wait to that last minute. And you do need that open dialogue. Like, hey, you need to know what's there. If you say, hey, give me all your tax documents, give me the W-2, the 1099, all that fun stuff. If you don't even know it exists, like, how do you know to ask for it? Like, when I run a financial plan, I'm asking for your financial blood work. I want to see everything. What is your total balance sheet? And there's nothing more irritating that you run through a plan. You have to show different kind of what ifs to make the numbers work. Oh, you might need to work a little bit more. And they're like, oh, what if I had like 200K over at Fidelity? Would that make it look better? It's like, yes. Well, like, why didn't you tell me? Oh, well, I don't want you to manage that. Like, what? You don't want them to report taxes? I know you got to start seeing like some of these random ones of you got the crypto, you have some of these people that, hell, what if I just don't tell you? Or, hey, I'm going to make a Roth contribution and just, Roth sound good, but you're making healthy six figures. Could you even do that?
Correct. Yeah. And that's some of the conversations which lead to, you're thinking you're saving money by not involving your trusted advisor group. And then in reality, you're probably costing yourself not only more tax dollars, but you're costing yourself more in professional fees along the way because you're not being forthcoming and just communicating with that individual.
Google knows a ton. There is great information out there on Google, but they don't know your situation. Like, there's so many nuances. Google can just give you the high level, that one size fits all thing, but they don't know you. They don't know like that. Everyone's a little bit different. How do you have 1099 income versus W-2? Do you have K-1s? Like, I know it's letter soup of IRS documents, but Google doesn't know that when you look that up.
Yeah, they're gonna, it's more and more as people especially with like a lot of people have side hustles and they're in the gig economy where they got some other source of income. A lot of people are getting into rental real estate, or they invested in like a REIT. It's and there's the better than me is the the very swath of generational wealth that now is being passed on from the baby boomer generation. And, now that some of them are passing, you see that wealth and it's got tax effects, it's got financial planning effects. I mean, it spills into both areas.
Oh yeah. And if you think you can do it on your own on top of work and take care of family and everything else, like, Godspeed. And typically by the time, and think about it, oh, they messed up, I got an audit, I need help. Suddenly TurboTax isn't as helpful as you hoped it would be. And oh man, you had stock options, you had all this stuff. But how about, we can go down that rabbit hole enough, but like, and then they do some planning. You got to do it. So we're now in 2025. 2024 planning is done. 2024, that ink is dry. There's not really much you can do. Typically, if you have a big tax problem, opening up an IRA is not fixing it right now. Like, that ship has sailed. At this point, you need to start looking, hey, do I need to make estimated tax payments? What are we doing for 25? So and because somebody's going to get that surprise in March and you're like, hey, you owe Club Fed $38,000. You owe your state 10, and they're going to just be blindsided because they just went about it. They didn't think, oh, I got a big bonus. I got my stock options vested. They didn't think twice about it. So definitely do the planning. Same thing with financial planning. You get an open dialogue, do it ahead of time. Don't procrastinate. But how about this one? This is the one, hey, tax refund versus owing taxes. Like, my personal mantra, I try to get it plus or minus $1,000. But you hear, I got family members, friends that are like, oh, can't wait to get that tax return. Oh, I'm going to get $8,000 back. Like, why is that a dumpster fire?
That's such a common misconception. If you relate to the size of your tax refund to how well your tax advisor or CPA is, representing you, I think that's a common misnomer. It's just, if you're getting a very large refund, you should be worried in the sense that that money could be working for you much harder on the outside. You're basically giving an interest-free loan, as you know, to the IRS and Club Fed. It just doesn't make any sense. And there's so many other ways you can better suit yourself with that money in your pocket versus theirs.
And now, years ago, Club Fed, if you underpaid and owed them money, the interest rate was fairly low. What is it now? 7, 8?
It's closer to 8.
It's not exactly cheap to owe them money. It's like a
No,
credit card light.
no. And, as the technology advances, they're getting more and more creative as far as communicating that to you and finding you. I mean, that's, you really should be on top of it. The lack of, if you got bad record keeping, you know, talk to your tax accountant, talk to your financial planner. They've got a network of people that they'll put you in touch with the right people to get you more up to speed of where you should be.
Yeah, and here's another thing: you run into, oh my god, I'm a 32% taxer. I hit that bracket. Oh my god, what most people, it's a graduated tax. Like it's a little
Yes.
column. I use the Holistic Plan software. You've seen it. You're a CPA. You file. You know how to look at this. But for the average
Yep.
person, you show them like that little like stacked. All right, for the first 40,000, you paid this. Then this was at this. Your average rate, what you actually effectively paid on every dollar, average. Oh, it's 17%. But yes, that last 50,000. Analogy I've heard, it's a layer cake. Only the top layer gets hammered, right? So it's not the entire cake, it's a retro all the way back.
It is. And that's something that, especially with somebody that works at a publicly traded company, or even a smaller, larger, privately held company, is you're getting, say you get profits interest, or you get RSUs and stock options. Well, a lot of that falls right on your W-2, and it creates more taxable income. The onus is on you to make sure that you have enough withheld, and it usually bumps you up into the next tax bracket. And, you should be leaning on your trusted advisor group, the financial planner, and your CPA to help you navigate that process and what that looks like for you from a tax perspective.
And you want everyone working together. Like you and I work hand in glove, not just because you beat me and our history together, but like we're peanut butter and jelly. At the end of the day, taxes and investing, we can't be both. You can't be both good at both, but both have to be covered. We have to work together, and it may not be you and I, but I get to work with a CPA. And one of the things we did our little prep yesterday was talking about, like, if you work with a financial planner, you work with a CPA or an estate attorney that doesn't want to play with other people, like how do you sit there and say, hey, I don't want to be all rowing in the same direction? At the end of the day, we're here. Our job is to do the best we can to help our clients to be in the best financial situation possible, minimize their tax bill, make sure their legacy is what they want with the estate, and make sure their investments are doing what they want to do. One person can't do all three of those.
Yeah, I couldn't agree with you more. You should seek out that person that has, especially from the tax side and a financial planning side, that wants to work in tandem with your trusted advisor group, even your attorney group. It's very important to have that synergy of efforts.
Getting back on track. Here's another one. Hey, I'm 1099. You've been 1099 at previous times in your career. It's always, oh, it's a write-off. Just write it off. A deduction versus tax credit. You get to deduct some business expenses, but it's at your tax rate. Some of it, meals and entertainment aren't dollar for dollar, all that other stuff. Tax credit. That's where you want. Give me a tax credit. That's the preferred one, isn't it? But everyone uses them like they're like literally Coke and Pepsi when they're not.
No, they're not. And deduction is a deduction based on your overall effective rate. And then the tax credit, you got to look at what type of tax credits, whether it's a child tax credit, which is, you got to look at your income level, or some of the other energy tax credits. Those are subject to your general business limitations as well. I mean, it's really, there's a lot of interplay. And if you have substantial tax credits or deductions that you're looking to utilize, you really should do a projection to make sure that you have that you're making the right investment choices based on your particular situation. It's very important, because you might say, for instance, somebody might invest with you thinking that, oh, it's going to be 15% long-term capital gains, when indeed they've got so many other sources of income that it puts them over a $600,000 threshold, where those long-term capital gains are being taxed at 20%. And it's a common misnomer. It's just not.
And how about the business owner, like the default go-to? Oh, I gotta buy the heavy vehicle to get my deduction. Aren't there so many other ways they could use money more than a depreciating asset? Like, aren't there ways to minimize that tax bill other than being like, let me get that Range Rover?
I couldn't agree with more. Is it's one of the most you know absolutely depreciating fault. There's no appreciation in something like that too. Why wouldn't we talk about investing in a robust retirement plan that you supercharge and fund it very heavily, especially if if you got in a company that you've got a class of employees, or maybe you're just a sole proprietor with an LLC, that you could really put that money to use in a different way. There's so many other options as well.
But that goes into kind of our next bullet point, tax planning. Like, if you talked about this versus just being like, oh, I had a good year, let me go to the Audi dealership. Yay. Like, don't get me wrong. I got my current vehicle during COVID. I love my Tahoe, the big diesel. But like, do I really go spend, I don't know, 80, 90, 100,000 to get a deduction? Eventually that car's gonna be worth zero. Like, Bo's gonna be real happy when he gets his license in a couple of years to take that one over and be like, oh, look at this shiny one. My dad owns his own business, so he gets a car every year.
Yeah.
But isn't that why you got to do planning? You can show them the math versus, hey, they're going to the dealership at Christmas to get the big red bow on it. And like, here's my big red deduction.
Even if you finance it and you don't have the cash outlay, you still got, the debt that you got to service. And no, that conversation is always well after the fact of the purchase. Is you're looking to find deductions when, why aren't you looking to keep some cash flow for working capital so you can grow your company in a different way, whether it's hiring out people on a contract basis or investing more in your employee base. It's or different equipment. There's so many other conversations to be had.
Yeah, there's more than one way to take care of that or trying to minimize your tax bill without just making the dealership happy with you.
Correct.
Now, it's always last couple of years, it seems it's like that last week in December, Congress, the government always make those little last minute changes. Like, we got an election cycle just coming through. There's always the headline risk of what's coming. And how does the average person keep up with all the tax changes?
Yeah, that's a great question. Is especially in the climate that we're in with a new term or new president coming in, is you're going to see the current tax law that was started back in 2017 is now going to sunset, and a lot of the provisions are on the table where they're going to revert back to what they were before, which are a lot of them are unfavorable compared to what current tax law is. So there's a lot out there where it's going to prioritize it, and you're going to see change in the within the next couple months. But there's also a lot of analysts and professionals like myself I don't think it's going to be done in short order because there's just so much at stake. And we got to look at it from the perspective of, okay, well, there's no easy task because it's already really great rates, even though people don't really understand that. But I think it's going to be either the same and they're going to kick the can down the road, or they're going to increase the rates.
Government kick the can down the road? Come on.
Well, I know it's, you'd like to say that they would do something very quickly so everybody can plan, but the likelihood of that happening, I don't see it happening.
One of the stats that recently came out, they were like talking like, oh, these tax cuts are costing money. They need to expire and raise rates. They were showing that the IRS like inflow is up, like that we are getting more. There is record tax collection. Shockingly, this is like me. My exercise, why I'm still fluffy, is hey, if you eat more than you exercise, you're going to get bigger. The government spends more than it's taking in. Like this is equal. This is more of a spending problem at the moment than a tax collection.
Yeah, and you're gonna see, you'll see. I don't like the Social Security and the Medicare. Will we see reform? I don't know within the next 4 or 5 years, but by the next 10 years, it's got to be addressed. There's issue with the funding of it.
But isn't one of the easier ones I've always seen is raising FICA? Like, hey, because what does it phase out at what 146,000 of earnings, somewhere in that range, 160?
For 2025, it's closer to 170.
But if you bump that up to 400, doesn't that it kind of stretches us out a little bit?
It does.
It doesn't fix everything.
No, it doesn't. But the other side of that, as you know well, is okay. Well, you're going to raise the FICA base, and most of those people that are affected, those are the people that create the jobs. So it's really a double-edged sword. They're going to find a different avenue to get that money to them without paying the payroll tax.
Yeah, somehow, some way they're going to get it. It's like, I moved to a state with no income tax. I'm like, they're not running that stuff on free. You're going to get it somewhere. It might be real estate. It might be sales tax. Like, it's not live free or die. Like, they're going to find a way to, they're going to get you. Like, it's not, they're like, it's something else. But let's go into a little bit more of the fun stuff. Hey, you get success, your family's taken care of, numbers are good. You want to also feel good with your money. Everyone do good, feel good. Talk to me about some of the gifting. What are some of the things you're starting to see the last couple of years be a little more prevalent, or just at least ideas you're bringing up? Some people say, screw it, I want my last check to bounce, and they have no like legacy idea, even if they have kids or not.
Yeah, a great question is, based on, just to add to what I was saying, the generational wealth, especially that you see a lot of the people that are selling their businesses right now. They're setting up what's called a donor advised fund to create a legacy well after them, and create that not just for them, but also to keep it in perpetuity. As far as you see private foundations set up, you see people doing converting RMDs to QCDs. I mean, there's a multitude of.
Hey, Mr. OPP, what is QCD? We can't do just words. What is a QCD? You and I know what this is, but there are going to be, our mothers will be watching this and want to know what that means. All right. To Debbie and Cindy, we thank you for listening this long into the show. So
a qualified charitable distribution is basically, you are required to take at a certain age, 73 or older, if you're not already taking RMDs, is you are going to take that RMD, convert it, even if it's not an RMD, and you want to take an IRA, a distribution, instead of you taking cash that you have sitting on the sidelines and giving it right to the charity, you have your financial institution, you'll work with somebody like Nick and say, I want it to be directed to, the American Heart Association, or, whatever charity endeavor that you so choose.
But I'm going to lead the witness here. Why does it matter more that you send it directly to versus, hey, my RMD, I get it every September. My advisor sends it to me automatically, and then I write the check to the church or the 501c3, whatever it might be. I know I'm leading the witness here, but here, I'm going to set it up. You ready?
Great question. So it reduces your taxable income dollar for dollar up to I think it's 105,000, and that reduces your taxable income and converts it from just a deduction to a dollar for dollar reduction of your overall ordinary income tax base, which is great. I mean, if you're gifting a significant amount of money, you should really look into that. I mean, it's a very favorable part of the tax code.
Yeah, and there's a lot of people that I have as clients. Oh shit, I got my RMD coming. What am I going to do with this? I have nothing. I'm like, well, what's important to you? They're like, me. I'm like, okay, charity starts at home, but if you even had any inkling of a church, like, I don't know, American Red Cross, pick it, whatever it is. What's important? Maybe like cancer research, whatever that might be. If you're living good and you want to do good, hey, feel a little warm and fuzzy,
Yep.
like this is a nice way. Lower your tax bill, save on taxes, like take care of yourself. And that's one of those things of, do you really want to have $1 million funeral, or do you want to see some of the hard-earned dollars like do good? So, hey, I tell people, like, give while you're there. Like, give your grandkids or something, or take them on that trip. Do that gift now so you can like enjoy it. Hey, I worked my ass off my whole life. Do it. You do something out of this, or you take your RMD and repurpose it. You don't need that money. Give it to that charity. They're going to be appreciative. You're going to see, oh, hey, they were able to, whatever it might be. Like the church was able to build the gym that they wanted to do. They had whatever it, like, but you actually get to experience it versus people like, I don't know, thanking like the memorial fund. Like it's on the back end. Like in you worked your ass off for your money. Why not and see it? See your loved ones enjoy it. See your church or whatever it might be, the hospital, whatever it might be, enjoy it in your lifetime. Like there's, always think it's a little weird when they're like they leave it to them after they pass. Nothing wrong with it. It's still generous, but why not enjoy what you actually did?
Yeah, I've actually seen some grandparents that are giving money to the schools that their grandchildren are going to for certain, like a science wing or, a field that's never been redone in the last 50 years. I mean, there's a lot of creative ways you can utilize that money and put it to good use. And I think it's something that everybody should look at, especially if they have the opportunity to give back.
You said it. If you have the opportunities, there are some people, they need their RMD, they need their Social Security. That's life is more expensive the last couple of years. Charity starts at home. I'm not saying go ramen noodles because you want to donate money. There are certain people that just some luck, some great success, some inheritance. You talked about the generational wealth. You're starting to see these people coming in the money. Like charity starts at home, but this isn't for everyone. Not everyone fits those donor advised funds. Those are great, but it's more, hey, W-2, big, that 7-figure income and having some ability. But these are all, there's so many crazy strategies that you can do that a Google search isn't going to do this for you. You got to sit down with me or Mark or your CPA. Like you need that trusted partner to take care of it and really cut through the bullshit for what's it matter for your situation, not your neighbor, your coworker, your cousin. Like, sitting down, ripping through the numbers, and then making an informed decision. Most of my clients, I'm pretty sure yours, like they're successful in their field. They're smart. They can process a lot of things. We got to find a way to explain it, and they'll make an informed decision. They just need to understand how it plays out for them. If we do X, what happens to taxes? What happens here? Like, look at both sides of it. And Google's not going to do that for you. Google's going to tell you the boilerplate, and that's the difference of working with somebody. But
I think it's great is, I know you do a lot of planning meetings. I encourage my client base to reach out to me when they're talking with their financial advisor like you, Nick, because I think it's very important. Even if I'm on a 3-way call for 10 minutes and we solve 2 or 3 angst issues or tax questions alongside with some of what initiatives that they want to do from the financial planning and estate planning side. I mean, it's such well time spent and gives peace of mind to mutual clients or any client for that matter.
20 minutes for peace of mind is priceless. Like why kick the can? Why stress? We're here. Mark and I, we work together a good bit. We can do a Zoom. Like technology, it's not like, oh, how do we get together all in the same room? We can knock out a Zoom pretty easily, get your mind at ease. But we're gonna have to drag you on after tax time, maybe after you get your suntan. But man, I appreciate you taking the time. I appreciate you smiling on camera. But this has been fun. Hopefully, we'll get you on again, and hopefully you survive tax season. But yeah, take nothing else out of this. Like, take the time to do some planning. Don't wait to the last minute. Have some partners that help you. Like nobody's 007 of finances, of estate planning, tax. Like you can't really do it all. Mark, how do they reach you if they want you to un-F their taxes? How do they get to you?
My firm's name is Verdolino and Lowey. We're located 1.5 miles right from the Gillette Stadium, the New England Patriots. So we're right on Route 1 in Massachusetts.
CMGI Field.
Yeah, you can, call my office. I tell you, there's a multitude of ways to get in contact with me. Happy to help in any way I can.
RJ's bumping this one up. The last guest kind of called me out on it. They're like, if they listen to your podcast this long, they know how to fucking find you. So hopefully Mark has helped unf your taxes. I'll help unf your finances, and looking forward to the next episode.
Excellent. Thank you, gentlemen. I am too. Looking forward to your next podcast. And thank you for listening to today's Unf Your Finances podcast. Please like, follow, and share this podcast with friends and family, because Nick wants more than his mom listening to the podcast. Until your next Unf Your Finances podcast, I'm RJ Malik.
Thank you for listening to the Unf Your Finances podcast. Click the follow button to be notified when new episodes become available. Visit our website at www.stgeorgewealth.com or give us a call at 828-481-8836. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of St. George Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA and SIPC.
Any guests in their company or companies are not affiliated or endorsed by LPL Financial unless otherwise stated. Individual tax and legal matters should be discussed with your tax or legal professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal.